Investing for beginners. How to start investing and grow your wealth. Welcome to our video on Investing for beginners. How to start investing and grow your wealth. Investing is a powerful tool that can help you build wealth, achieve financial freedom, and secure your financial future. Whether you're just starting out or you've been investing for a while and are looking to improve your strategy, this video is for you. We'll cover everything you need to know to get started with investing, from the basics of what investing is, to the different types of investments available, to tips for success. By the end of this video, you'll have the knowledge and confidence you need to start investing and grow your wealth. Types of investments. Investing involves putting your money to work with the goal of earning a return over time. The most common types of investments are stocks, bonds, mutual funds, and ETFs. 1. Stocks. Stocks represent ownership in a company. When you buy a stock, you are buying a share of that company, making you a partial owner. The value of stocks can be volatile, and they can go up or down in price based on various factors such as the company's performance, industry trends, and overall market conditions. Stocks have the potential for high returns, but they also come with higher risk compared to other investments. Investing in stocks can be a good way to grow your wealth over the long term, but it requires careful research and risk management. 2. Bonds. Bonds are a type of debt security. When you buy a bond, you are essentially lending money to a company or government in exchange for regular interest payments, plus the return of the principal amount when the bond matures. Bonds are generally considered less risky than stocks, and they can provide a stable source of income. However, they also offer lower returns compared to stocks. Bonds can be a good way to preserve capital and generate income, especially for investors with a low risk tolerance or a shorter investment time horizon. 3. Mutual funds. Mutual funds are a type of investment fund that pools money from many investors to invest in a diversified portfolio of stocks, bonds, and other securities. Mutual funds are managed by professional fund managers, who make investment decisions on behalf of the investors. The value of a mutual fund is determined by the net asset value, NAV, of the underlying investments. Mutual funds offer diversification and professional management, but they also come with fees and expenses. They can be a good option for investors who want a diversified portfolio without having to manage it themselves. 4. ETFs, exchange-traded funds. ETFs are similar to mutual funds, but they trade on stock exchanges like individual stocks. ETFs also pool money from many investors to invest in a diversified portfolio of stocks, bonds, and other securities. They offer the same benefits as mutual funds, such as diversification and professional management, but they usually have lower fees and expenses. ETFs also offer more flexibility, as they can be bought and sold throughout the trading day at market prices. They can be a good option for investors who want the benefits of mutual funds with the flexibility and lower costs of stocks. Setting investment goals. Before you start investing, it's important to set clear investment goals. What are you investing for? Do you want to retire early, buy a house, pay for college, or something else? Having a clear goal will help you determine your investment time horizon and risk tolerance. Your time horizon is the amount of time you have until you need to access your money, and your risk tolerance is your ability to withstand losses in your portfolio. Both of these factors will influence your investment strategy and the types of investments you choose. For example, if you have a long time horizon and a high risk tolerance, you may choose to invest in stocks, which have the potential for high returns but also come with higher risk. On the other hand, if you have a short time horizon and a low risk tolerance, you may choose to invest in bonds, which offer lower returns but are generally considered less risky. Creating an investment plan. Once you have your goals in mind, it's time to create an investment plan. This involves deciding how much money you want to invest, how you'll diversify your investments, and how often you'll contribute to your investment account. Diversification is the process of spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. Dollar cost averaging is a strategy that involves investing a fixed amount of money at regular intervals, regardless of the market conditions. This can help reduce the impact of market volatility and lower the average cost of your investments over time. When choosing an investment platform or broker, it's important to consider factors such as fees, investment options, and customer service. Make sure to choose a platform that fits your needs and budget, and that offers a wide range of investment options and educational resources. Risk management. Investing always involves some level of risk, but there are strategies you can use to manage that risk. Diversifying your investments across different asset classes and regularly rebalancing your portfolio can help reduce risk and maximize returns. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation, which can help keep your risk level in check. It's also important to stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. Remember, investing is a long-term game, and it's important to stay focused on your long-term goals and not get discouraged by short-term losses. Additionally, it's important to have an emergency fund in place before you start investing, which can help you weather financial setbacks and avoid having to sell investments at a loss. Tips for success. Here are a few tips for success. Start small and gradually increase your investments as you become more comfortable. Continue learning and staying informed about the markets. Be patient and stay focused on your long-term goals. Don't be afraid to ask for help or consult with a financial advisor if you need guidance. And finally, remember that investing is a marathon, not a sprint. Stay disciplined, stick to your plan, and you'll be well on your way to achieving your financial goals. Additionally, it's important to review your investment plan regularly and make adjustments as needed. This can help you stay on track and ensure that your investments continue to align with your goals and risk tolerance. In conclusion, investing is a powerful tool for building wealth and securing your financial future. By following the tips and strategies we've discussed in this video, you can start investing with confidence and grow your wealth over time. Remember, the key to successful investing is to start early, stay disciplined, and keep learning. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more videos like this one. And if you have any questions or need further assistance, don't hesitate to reach out. We're here to help you succeed on your investment journey.